You just finished a long day, mentally drained, physically drained. So without even really thinking about it, you pick up your phone and you start scrolling. Then you find some finance content. It feels educational, it feels productive. One video leads to another. Day trading, real estate, side hustles, cryptos, IRAs, taxes, index funds. Everybody sounds confident and everybody has the answer. You look up, an hour has now passed and you are more confused and more unsure than when you started. If that sounds familiar, this video is for you. Here's what I want you to know before we go any further. It does not need to be this complicated. And in the next 15 minutes, I'm gonna give you 9 principles that cut through all of it. Simple enough to remember and powerful enough to change everything. 3 sets of 3 principles, the operating system for your entire financial life. And I'm gonna show you what they actually look like when somebody applies them. Starting from 0 on a modest income before the age of 30. Let's get into it. My name is Ethan Ho, certified financial planner and the founder of Claw Capital Partners here in Hawaii. I've spent over a decade doing financial planning with high earners and families here in Hawaii. And what I keep on seeing over and over again is that the people who are building real financial freedom are usually not the people doing the most complicated things. They are the ones who got the fundamentals right and stayed consistent. If you want real practical content, not clickbait, but content built for real people who want true financial peace and security, hit subscribe and follow along. All right, let's go. Before the 9 principles, I want to say one thing directly. The financial content that you are probably consuming online is not necessarily wrong because it is complicated, but it could be wrong for you right now because it is skipping the foundation. Day trading, high-risk investments, complicated tax strategies, or alternative assets, none of those matter if the foundation underneath them is not solid. And most of the people reporting them either already have the foundation or are trying to sell something. The fundamentals are not exciting. They don't go viral. Nobody makes a thumbnail on living on less than you earn, but the fundamentals are what actually work consistently, reliably, and over time. So we are going to cover 9 principles in 3 sets of 3. Let's start with the first. I want to tell you about a client who came to me after years of day trading. Smart, disciplined, did their research, and they had big wins, but they also had big losses. And over time, they started to realize that it was more like gambling and not investing. And you know what they say, the house usually wins. And what I remember most is not the financial cost, it's what they described happening to them mentally. Constantly second guessing every trade, losing sleep over their decisions, checking their phone at 2 a.m. and just spiraling. And despite all that time, energy, and stress, they were not moving towards their goals in any systematic way. And that's when they hired us for asset management. Not because they could not trade, but because they realized chasing the highest return was costing them something more valuable than money. So here's what that story taught me about what actually drives financial success. There are 3 variables: time, money, and rate of return. Most people obsess over rate of return, which fund, which strategy, which investment. But rate of return is the least impactful out of all 3 variables and the one that is most outside of your control. The 2 variables that matter most are time and money. How early you start and how consistently you invest. Starting just 10 years earlier usually means 1 extra double of your money over your lifetime. So think about what that actually means. If you retire at 60 with $3 million, that extra decade of compounding could mean retiring at 60 with $6 million instead. It is the last double that is the most meaningful, but it all begins with starting earlier. And here's the math that most people never hear. Avoiding loss is more important than maximizing gain. If you lose 50% of your investment, you need 100% gain just to get back to even. A boring, consistent return that avoids catastrophic loss will almost always outperform the strategy chasing the highest upside, mathematically and emotionally. And this is actually how we manage money at Claw Capital. We are not hunting for the highest performing asset class, we're trying to avoid the lowest performing ones. It is easier to avoid the losers than pick the big winner, and we find that it works better long term. So here are the first 3 principles. Principle 1, start as early as possible. Time is your most important asset. Every year you wait is 1 year of compounding you won't get back. Principle 2, invest as much as you consistently can. Not the theoretical maximum, the amount that you can commit to through market cycles and life changes. Principle 3, focus on avoiding loss instead of maximizing gain. Consistent and reasonable will beat volatile and exciting over any meaningful time horizon. Now here's the thing about time and money as variables. They only work if your behavior supports them, which brings me to the second set of principles. Early in my career, I worked with a lot of people in their 20s and 30s. And I noticed a pattern. The ones that built something meaningful all lived within 3 specific behaviors, whether they realized it or not, whether anyone had told them this or not. And the ones who struggled financially, regardless of how much they earned, were violating at least one of them. Let me show you what that looks like at the extreme. I worked with someone making $100,000 a month, more in a single month than many people make in an entire year, but no meaningful assets, 6 figures in credit card debt, 2 auto loans, and 0 financial peace. And this is not because they are unintelligent or because they didn't care, but because they were violating all 3 of these behaviors simultaneously. And what that showed me is one of the most important financial truths I've ever learned. Income does not fix behavior, it amplifies it. More money flowing through a broken system just breaks it faster. So here are the 3 foundational behaviors. Principle number 4, live on less than you earn. The gap between what you earn and what you spend is the engine that feeds everything else. No gap, no progress. And let's be practical here. I'm never saying never upgrade your life. When your income grows, I coach my clients to do both. Take half of that raise and use it to enjoy life now, but take the other half to increase your savings and your investing. Because tomorrow is not promised, but neither is a comfortable retirement if you spend every raise before it has the chance to compound. Principle number 5, avoid bad, high interest rate debt. Not all debt is equal. A mortgage could be a reasonable financial decision. Credit card debt at 20+% interest is one of the most expensive financial decisions you can make. High interest rate debt works against compounding instead of with it. And every dollar going to interest is a dollar not building your financial future. Principle 6, pay yourself first. Most people spend first and save whatever is left over. And there's almost never anything left if you do it that way. Paying yourself first means the investment goes out before you even see it. Automated, consistent, and non-negotiable. Not what you have left at the end of the month, the first allocation as soon as the money arrives. These 3 behaviors are not complicated, they are not exciting, but they are the difference between the person making $100,000 a month with nothing to show for it and the other person making a fraction of that building something real. Now those behaviors are what create the gap between what you earn and what you keep. But a gap without a structure is just money sitting in a checking account without a clear direction. You need a system to direct it, and that is the 3rd set of principles. Think about a tripod, 3 legs, each playing a specific role, each one necessary. Remove any one leg and the whole thing falls. Your financial structure works the same way. Principle number 7 is cash management, the first leg. Cash is the glue that holds everything together, so I want to be clear what cash is really for. It is not there to make you money. It is there to let your investments make you money and to let you sleep peacefully at night. A fully funded emergency reserve means when the market drops, you don't panic sell. When something unexpected happens, you do not go into debt. When life gets complicated, you don't pause your investing. 3 to 6 months of your actual living expenses. Liquid, accessible, and untouched, doing its one job. And in Hawaii, where cost of living is high and income opportunities are more limited than the mainland, this leg matters more, not less. Principle number 8, wealth management, the second leg. This is where you build assets that can go up in value and produce an income. Assets that outpace inflation and compound over time. Stocks, bonds, real estate, each one plays a different role, but the point of all of them is the same. One day, you want your assets to support your life without requiring your full-time labor. The goal is not the highest return. The goal is to protect against loss while building consistently until the day work becomes a choice. But wealth management only works consistently when the first leg is in place. Principle number 9 is risk management, or the 3rd leg. This is the leg that people skip most often because it feels like a distant problem, something to deal with later. And frankly, most people have negative feelings towards insurance until a disaster arrives. Disability, death, a major health issue. These are not abstract. These are the things that quietly wipe out otherwise solid financial plans all the time. Insurance is not an investment, it is a transfer of risk. You are paying a known smaller cost to protect against an unknown larger one. Get this leg in place and then you can build the other 2 with real confidence because you know the plan survives even if something goes wrong. 3 legs built together working together. Now let me show you what all 9 of these principles look like when somebody actually applies them. Starting from 0 on a modest income. When I was just starting to build my own practice after leaving a national firm, someone came to me who trusted me before I had a long track record. I took them on because I believed in what we could build together. They were making under $100,000 a year in Hawaii with no prior investment experience, starting from basically 0. We worked on all 3 principal sets together, not one after the other, but all at once. In the beginning, the emphasis was on cash, building the emergency fund first because without it, everything else is fragile. But even while building this foundation, we were contributing to wealth management and putting the risk management in place. The tripod went up together. One leg just got more attention at the start. 5 years later, before turning 30, they have a few $100,000 invested, a fully funded emergency fund, intentional risk management in place, and now they are going back to school part-time to increase their earning potential while still maintaining a healthy savings rate. The system held even when life got more complicated. But here is the moment I want you to hear. Earlier this year, they had accumulated more cash than their plan required. The headlines were ugly, the market was volatile, and fear was in the air. We sat down and we looked at the numbers. Their emergency fund was fully intact and they had more cash above and beyond what they needed. The fear was real, but they knew what the right number to hold in savings was. They knew they had extra dollars above it and they knew investing was necessary. So they did not let fear make the decision, they invested the lump sum. And then the market dropped and they did not panic. Not because they were not watching and not because they didn't feel it, because their emergency fund was still fully intact, the plan was still intact. Nothing had changed about their actual situation, life was the same for them. And then the market recovered, fully, past its previous high. They were not wrong to feel the short term, the drop was real. But by having everything in place, they were able to hold a longer view and now everything is paying off. In our next meeting, they shared something that I wrote down. They said that they finally understood what I had been talking about for the last 5 years. That cash is not there to make you money, it's there to let your investments make you money and to let you sleep well at night. They said knowing it in theory was completely different than feeling it and living it. That having the foundation in place meant fear did not make the decision, they did. And they said something else that I keep coming back to. They said that they could never have imagined having what they have now 5 years ago. And that having this foundation makes bigger future goals feel real. Not someday, but real. That is what getting the fundamentals right actually gives you. Not just money, but the confidence to believe that the bigger thing is actually possible. So here's what I want to leave you with. The next time you pick up your phone and go down some rabbit hole of financial content, remember this. The person talking about the most complicated strategy is not necessarily ahead of the person doing the simple things consistently. 9 principles in 3 sets of 3. Start early, invest consistently, avoid loss. Live on less than you earn, avoid bad debt, and pay yourself first. Cash management, wealth management, and risk management. That is the operating system. Not complicated, not flashy, not viral, but it works. Every time for almost everyone, regardless of income, regardless of age, regardless of where you at or where you started. I'm sharing this not because this is the client I'm trying to attract. I'm sharing it because I wished someone had shown me this picture earlier. The sooner this is clear for you, the sooner you can stop spinning and start building with confidence, with direction, and with real financial peace. If you found this useful, hit subscribe please. I keep putting out practical, Hawaii-specific financial planning content, and I want to make sure you see it when it comes out. And if you want to have a real conversation about your financial picture and what building this foundation looks like for your specific situation, this is exactly the type of conversation we have at Claw Capital Partners. Head to clawcapitalpartners.com, schedule a discovery call, and I'll see you in the next one.